Welcome back to the Noble Theory podcast. Today we are talking about the real estate market. Boy, there's a lot to unpack here. I think one of the biggest problems we've had to get to this point in 2025 is it really comes down to supply and demand. But if we unpack each of those things, the supply and demand and how they're related, you really start to get into the logistics of what happened and how we got here. I think there's two big, huge contributing factors to the current situation. One is the 2009 real estate bubble, when the whole real estate market sort of collapsed, the phony loans by certain companies that wrote loans and gave people mortgages that they knew 100% these people couldn't afford, and those houses would be foreclosed on. And then the second thing is the pandemic. Those two factors have really been driving forces to get us to this crazy situation where nobody can afford a home.
So I agree with the time or the
2009.
the timeline, but the driving episodes, right? So the housing boom and then the following bust. I think that's an important time dimension and an event. And I also think that the pandemic period is also an important event.
Well, because it had to do with people working from home and offices closing. And
that some of it did. Some of it did.
70% of people can't afford a house in their home state. 70%. That's not the American dream.
Right.
And so think about that. And
so it's interesting. The American dream, as we know it, is not always been the American dream.
Well, we're getting into this thing about generational wealth and how you build wealth.
No. Just the propensity to own your own home. That has changed over time. So prior to 1947, home ownership rates were in the low 40s, 42%, 45%.
And homes were also 10 grand.
Or cheaper. Sort of in the by the early 50s or so, that jumps up to be something approaching 60%. A few years after that,
home ownership, you're saying
63 and it's been stable from 63 to 69% from about the early 50s on since then. So there was a policy change in the government to induce people to buy and own homes. Particularly, the World War II vets returning from World War II were given GI benefits that promoted home ownership. And that's part of the movement from that 42% home ownership rate to a home ownership rate above 63%. Benefits. Government subsidizing in some way home ownership.
So do you think that is the government trying to, I don't want to say force, trying to push the idea of home ownership as a way to build generational wealth, right? To over time.
It could be, or it could also be that it was a very important driver of economic activity and GDP growth. And so the auto industry was also a very important economic driver.
Well, there's also
GDP growth, and so both of these are encouraged, right? The auto industry was encouraged by building a very elaborate network of high quality roads throughout the country. The real estate, industry was promoted by providing GIs with very low cost mortgages or long term 30-year mortgage notes, certain subsidies that they didn't have to have, certain credit scores and so forth that we just recognize today. They could get a home without having a lot of the same stuff that we have to jump through today to get a home.
Well, and two, I think also it's a little bit not quite so clear cut, but the Norman Rockwell sort of image of a home with a picket fence and a golden retriever in the front yard.
It's a beautiful life.
It's a beautiful life.
Right?
It's a wonderful life.
It's a wonderful life. Yeah,
I liked it. It's a beautiful
life.
We should make a movie called "It's a Beautiful Life."
Well, I think there is a movie with Russell Crowe. Isn't that about John Nash? John Nash, A Beautiful Mind. It's called A Beautiful Mind.
Gosh,
what a great
all over the place
game theory.
Yeah.
Very good.
Cool movie. Yes, it came from the book, right?
Well, he's a mathematician. Yeah. John Nash was a mathematician,
which would help us try to break down the housing market. So, if you think about the idea of the stability of the American economy, the sort of middle America, you have a 9-to-5 job. Theoretically, you bring home a paycheck, you can afford a mortgage, you have the stability of home ownership, you're paying off the mortgage and building equity in the house from which you could presumably invest in a small business or buy a bigger house or buy a second house and rent it, or whatever the
But we all know very well, right, from is it Arthur Miller's Willie Loman character,
death of a salesman.
The Death of a Salesman,
Yeah.
right? He works his whole life to pay off his mortgage, and at the very end, he does he not even pay it off before he dies? He
Yeah.
drops dead like the month before he pays off his mortgage, and that was the big goal. So it could be that the promotion of a 30-year mortgage is to keep the economic agents, doing their
Engaged.
thing, engaged, doing
Yeah.
their thing, keeping the economic engine of the United States moving forward. However, prior to all of that, the United States economy was growing at rates that were much faster than the rates that were growing afterwards. So
Well,
it's not necessary.
part of that, this is a crazy statistic. Only 2 states in the country do the residents of those 2 states, Alabama and Wisconsin, spend 28% of their income or less on their mortgage. Only 2 states. Now that's sort of one of the staples of the banking business, the mortgage business, is this 28% rule, right? Debt to income ratio. And only 2 states currently, Alabama and Wisconsin, where the residents are only spending 28% of their income. This tells you how dire things are for people's their little economies, their budgets, their home budgets, rent, overhead, heat, cars, right? It's all.
So roughly that 1/3 mark is something that we probably all heard from our fathers. Buy a house that's no more than 3 times your household income. And so in many parts of the country, particularly the coasts, people spend something like 5% or 5 times, a factor of 5 times, or even 6 times in certain high cost places like Los Angeles or New York City, DC, and so forth. So that ratio has changed a lot. That 1/3 you're talking about was it Alabama you mentioned?
Alabama, Wisconsin, yep.
Right. So that's a very traditional number. Keep the house within 3 times or 1/3 your income, 1/3 of the price of the house.
And let's face it, part of that equation is the cost of living in Alabama, Wisconsin obviously would be on the lower side, I would assume. In the 50 states.
I imagine that certain other external conditions factor into it, right? Like desirability. Where do you want to live if you had?
Are you picking on Alabama, Wisconsin?
I'm not. In fact, Alabama.
The statistic is picking on
Alabama. Huntsville, Alabama has the highest proportion of PhDs in its population of any place in the United States, and it's not even close.
Why is that?
Well, that's because there's a lot of aerospace engineering going on there, space center development, spaceship development going on there, and so forth. And so a lot of companies are located in Huntsville, Alabama, and those PhDs are working for essentially the aerospace industry.
Well, and then the other thing to know is that the highest national average for the minimum wage is $16.10, and that's still not enough to afford a home in any of the 50 states on a 40-hour work week.
Yeah.
And that's another podcast, because raising the minimum wage solves one short-term problem, but creates a host of other problems because everybody else increases their prices in order to meet that minimum
wage doesn't solve any problem.
It's short-term. It puts more money in a person's pocket at the end of the week, but that doesn't.
So if minimum wage works,
I'm not saying it works.
Yeah. Then why not make it, instead of $10, why not make it $20? And if that works, why not make it $40?
Yeah.
Why not make it $50? If the minimum wage actually did anything, then why wouldn't you do that?
Yeah, you got to be careful with that really simple, clean logic, because there's nowhere to go with it. Just like mic drop.
Yeah, all it does is it causes the marginal cost of that labor to rise to a point where it makes more sense to automate rather than using labor, physical human labor. Use machines and capital to get the work done. And so you see this in Europe, where the pricing floor is raised high. There are no parking attendants in European car parks, as they call them in England or anywhere else in really Europe. They use machines that you put money in, and a machine opens the gate and lets you in, and so
There's
forth.
like one person sitting like
there's nobody
1,000 miles away. Well,
yeah, right, exactly. There's a computer operator somewhere.
Yeah.
And so here you have parking lot attendants, because the marginal cost of the physical capital to put that stuff in is higher than it is to have a person there rather than having the automation.
Uh,
So
Return on investment, in essence.
it's a return on investment,
Yeah.
right. So the important thing you're talking about, the cost. I created this podcast. I created some little table of data here.
Can
And
I mention one fact?
yes, absolutely.
Um, the prices of houses in this country is up 40% since the pandemic. Now, what are the contributing factors of that? Put those aside for a moment. That's just a startling statistic. Since 2021, 40%. Real estate prices have increased single digits historically since the beginning of time, in essence, right?
Right.
I mean, a 40% increase seems it's not an anomaly. The pandemic
So,
really.
so there are a lot fewer homes being sold right now. There's a lot going on with all of those numbers that we've got to be very careful with, and we'll try to parse them out right now. So you mentioned that 2009 timeframe, and what happens there is the Federal Reserve drops the interest rate to practically zero, and then they through quantitative easing really make
bond buying. Yeah.
effectively make the price of a loan negative. It's a negative interest rate if you look at it in terms of the real rate, and so these negative rates or almost negative rates mean that the cost of borrowing money is almost nothing. And what do you do as the prices of anything drop? Right, you demand more of that thing.
Buy a bigger house is what you mean.
Well, not just buy a bigger house, you just demand. So a person who maybe wasn't in the market for a house is now pulled in, enticed to come in. And then people who are
Are you
already
saying
in the
buying a
market.
second house or buying a house they don't need?
No, I'm saying that a person who was happy being a
Oh,
renter
I see. Yeah.
and they weren't really in the market for home ownership.
Jumps in.
But now the cost has gotten so low that they've been drawn into the market where they weren't in the market before.
It's a great point.
Then you have the people who are buying a bigger house or a larger house or a more expensive house than they would have bought previously because the cost of carrying that house is dropped because the interest rate has dropped. So those interest rates drive a lot of the demand that you're talking about. And then we see recently the demand. So you're talking about prices going up, but the demand for homes has actually curtailed a lot, and that's because the prices of homes, right, have gotten so high. And so right now, sellers are not willing to sell their homes, and so what they do, so because they want a high price. So the
Well,
people
they also need a high price so they can get into another house, which is where the price is also higher, right?
oh, right, and so but that additional you're talking about 40%. I've not quite seen a number quite that high, but the numbers I've seen are nearly that. Inflation is driving that. That's not zero interest rates.
Well, it's also supply and demand. Back to supply and demand, right? Because we're getting back into what.
Well, but the supply and demand, we've got a curtailment of supply, and we have a curtailment of demand. Now they could both level out at a high price. So supply and demand, the supply of housing, that is, the number of houses put on the market because of people who want to sell their house. People are holding off buying a house right now. They're
But
not doing that, so they're not putting their house up on the market. The demand for housing is not as high as it was. It's softened because it's curtailed because prices are very high. Again, price goes up, people demand less of it. Supply, people want a high price. They're not getting the high price, so they don't sell their house, right?
See-
So they're not putting them. But what happens is whenever you have a generalized inflation, the prices of all assets go up. And so that's why we've seen such a huge rise in the stock market. Gold has gone up.
Used cars.
Used cars have gone up. Houses have gone up in price, right? So this real estate is now following this pattern of all assets rising because of inflation.
No, so here's what I wanted to mention is, to me, the supply and demand equation, if I was being really crass about it, if there was a supply and demand of a ratio of, let's say there was 10 home buyers, prospective home buyers, people in the market to buy a house, and there was one house. When the supply is at that ratio, when the demand you're mentioning has softened, to me, that 10 to 1 drops to 6 to 1. Point being, while it's softened, the demand is softened.
Yeah.
It's only there's still way more demand than
Right.
there is supply.
There aren't enough demanders who are willing to pay the price, though, that they have to pay to get into a house, right?
The price point starts to become
That-
part of the equation.
That's right.
Yeah.
And so that's why they're pulling back. That's
Especially
why
entry level.
that's. But the people who own houses right now want a lot for their home. And so they may not be willing to put their home on the market right now because they don't think they're going to get the price they want to get.
But
for
see,
their home.
that's a slightly
Now, if they're
different.
forced into it, you have certain life events that take place, divorces, marriages, babies coming, right? It forces you to have to get a house and you have to pay whatever the price is, and you do. But
If you can.
right? And so you buy the house, even though the price is high. So that's how we have a new equilibrium price right now, right? The prices are equilibrating at a higher level than they were previously. But if you look at the actual numbers of transactions, they're not nearly what they were going back to, say, 2014, 2015, 2016. Much higher numbers of transactions taking place than there are taking place today.
I think if there was if there was a flaw in what you just stated, it would be, to me, that there's two distinct different categories of people. Obviously, first-time home buyers is very different than people that are in a house, and your analogy, in a house and trying to buy another house, and those people sitting back and saying, "Hey, I'm not getting enough money for my house. I'm not going to sell right now." That's a pretty pronounced different equation than the people that are trying to go from an apartment for the first time into a house. Why? Obviously, they don't have, supposedly, the equity in the first house that they're selling. They're going from zero to a house, not from another house that got 10 grand or 20 grand or 110 grand or $1 million equity in their old house. Now, that's, of course, part of the problem with the refinance. When people took money out of their houses, a lot of people were upside down. A lot of people don't have much equity in their house because they took the equity out of their home. Different conversation. But those first-time home buyers is really where it's the most. They're penalized the most trying to get into the home market in the supply and demand market.
Well, the one of the sources of demand for homes at all price points, particularly higher price points, though, is exogenous demand from abroad. So you're talking about external to the United States.
What you're saying, so it's a family that's not trying to buy a house; it's a business trying to buy a house.
No, I'm saying that a wealthy European or a wealthy Asian
An investment, yeah,
wants to buy a home, and where are they going to put it? Well, if you're a South American, if you're an Argentinian who happens to have money, or if you're a Brazilian who happens to have money, you don't want to keep your money invested in your local country because it's not as safe.
Yeah, volatility.
So
Sure.
you want to put that money in a house in Miami. And so, South America, wealthy South Americans are.
But you're saying not to move into. You're saying as an investment.
As an investment.
Got you.
So they buy condos in Miami, and prices in Miami are very high right now, and it's because a lot of it is because
rent and buying. Sure.
Well, they're related. The rent price and the purchase price are related, and so these wealthy people try to buy where they can, where it's going to be safe, where their money is going to
grow.
Not just grow. A lot of times they're worried about it being confiscated, or they're worried about their money being lost, right? So they buy into the United States. A lot of Asians buy into California real estate or Pacific Northwest, state of Washington, Oregon.
Safe investment.
And so forth. And so about 4%, there's a National Association of Realtors study that in 2024, 4% of the $1.7 trillion that was spent on residential real estate in the United States that year, 4% of that was from foreign investors or foreign purchasers, foreign buyers. So there's another study which is really interesting. This was a graduate student at Wharton School of Business, and she was looking at the effect of Chinese populations of foreign-born Chinese in local areas. And so she looked at several cities where they had high concentrations of foreign-born Chinese, and she found that home prices grew 8% more in these zip codes with foreign-born Chinese populations. This is from 2012 to 2018. So what happens? You move to the United States for a job, and you buy a house or you rent or whatever, Then you get settled in, start putting roots down. You start bringing your family over, right? And they want to invest in a house and buy a house, and they buy in the area that you're in. And so house prices tend to be very well supported in cities, markets where the job market is very robust, where lots of jobs are being created. In fact, in San Francisco, since 2012, they've experienced a 30% growth in employment. This is the Bay Area. But at the same time, they've only increased their housing units by 10%.
Doesn't take, you can do the math real
See,
simple,
so
right?
that is just simply the
Problem.
lack of supply,
Sure.
right?
Sure. Well, it's lack of real estate. The people that are trying to work in the Bay Area are trying to live in the Bay Area. Here's part of your equation just now. Speaking of these private equity firms that have invested in housing, kind of an amalgamation of statistics that are almost counterintuitive. Apparently, only 2% of residential homes in the U.S. are owned by private equity businesses, companies that are, for the sole purpose of investment, are buying single-family residences. Now, let's take BlackRock, for example. There's BlackRock, there's JP Morgan, there's a bunch of them. BlackRock owns a company called Invitation Houses, Invitation Homes. They sold it. It was a division of BlackRock. At one time, they owned about 60,000 homes. And in 2022, that investment, their return on that investment was 8.4%. The S&P 500 was down 19%. So think of the investment from BlackRock's perspective. Instead of the S&P performance of 19% in the red, you have 8.4% in the black. A ginormous swing, and part of the reason BlackRock's worth, hundreds of billions of dollars, $880 billion. BlackRock.
So in the wake of the 2008-9 financial crisis, a lot of people lost their homes. They were going into default. They were turning the keys back over to the bank and so forth. So banks aren't in the business of being real estate companies. They're in the business of making loans, right? And so what they did, what any rational business would do, which is they sold them at auction wherever they could at a discount, heavy discount.
They bundled them together, right?
In some cases, they bundled them together,
Yeah.
but they sold them, and investment companies ended up a lot of private equity companies purchased these homes, and they either did remodeling to them. When a home sits for a year or so or longer, it needs a lot of work to get it back on the market. And so they either prepared them for renting, or they prepared them for resale. But you have to realize that at the time, you always have, every one of us has the choice of either renting or buying when you make the decision to form a household. Households weren't really forming a lot during that period of time. People were staying with their family where they could. But a lot of these homes were second and third homes owned by someone who got in over their head, thinking that they were going to, a landscaper, a grass cutter buys 3 homes. Well, they didn't have the money. It was these cheater loans, liar loans, or whatever, and they bought these homes. They were renting them,
and didn't
or
need
they were
them to
trying
live
to
in.
flip them. They didn't need them to live in.
There wasn't a roof over their heads, so
they were,
let them go.
That's right. They let them go.
Yeah.
And so that's why a lot of these homes were sold at a very steep discount.
Yeah.
But I think there's something really important to consider here is the role of inflation. So the role of interest rates is very
I was just going to bring that up. I got something on interest rates too.
The role of inflation. So I went back and found a couple of key periods. The data really that I could find, 1984 would be the first period of data. And what I want to do is get past inflation. Inflation is and always will be the government creating money. That is the growth of money relative to the growth of the economy. And so we could then just compare the growth in GDP to the growth in the money supply. And if they're out of balance, that is, money supply is growing faster than GDP, you're going to have inflation.
Sure.
Every politician will argue that it's not that way. Every politician except for Rand Paul will argue that it's not that way, but because the government uses inflation as a way of generating revenue without taxing directly people. It's a hidden tax, right?
Insidious.
So in 1984, the median household income, now this is not average, This is not mean. This is median. So for every one that's above this number, there's one below this number. The median household income is $22,420. Then, at that time in 1984, the average home price in the United States was $68,000.
84. Okay. 60.
So if you take a ratio between the two, $68,000 home, $22,400 average income, that is a ratio of just over 3. Call it 3. This is that number.
Tucking into that 1/3 thing, right?
Yeah.
Nice.
This is historical. There's a reason why people say don't spend more than 3 times your income.
And you didn't have to.
Okay. So a car. So I used as my example for a car in 1984, I used a Honda Accord with the EX trim. Trim line is the EX. Most features that you want. So a Honda Accord in 1984 is $8,200.
New.
$8,200. And so
I'll take two of them.
that is
Wow.
that is 36% of the median household income at the time. 36% of it. All right. 1990, income goes to $29,940. Home price goes to $100,000. That ratio is 3.3.
Tucks right in.
3.3.
Yeah.
And that Honda Accord in 1990 is now $11,000. It's 36% of that
Close.
1990 income.
Going up a little.
2000, $41,990 for income and $125,000 for home price. That's 2.9. That's a factor of 2.9, multiple of 2.9. So we're really still staying in that ballpark of 3, 1/3. And the Honda Accord is now $18,300, which is 43% for income. So the Accord has gone up. We're going to talk about why this is happening. In 2010, income is $49,280. The average home price in the United States is $190,000. That's a multiple of 3.8. We're starting to move up a little bit, creep up. The Honda Accord is $20,300, which is 41%. I'm down just a tad. In 2020, $68,000 for the average income, household income, or the median household income. And the home price is $275,000. So now we're at a multiple of 4. This is in 2020.
Affordable.
Start of the pandemic. No, it's a multiple of 4. We're starting to
Creep up.
Yeah. The Accord is $30,300.
Wow.
And that is 44% of the $68,000 you would have earned that year. Well, the median income. Now in 2024, median household income is $80,610. And the average home price is $410,000. That's a multiple of 5. The Accord is $31,000. Means it's fallen to 38% of that household income.
House is up, car down a little.
Well, the cars have fluctuated a little bit, but one reason why the prices of cars go up relentlessly during that time, and the same thing with homes, is that the quality, you have to look into the quality of it. Cars got a lot bigger, a lot more powerful, much bigger engines, much larger spaces, which have much greater appointments. Every car has air conditioning. Every car has heated seats. Every car has power windows and doors and power hoods and whatever else, right? So you get a lot of nice stuff in that price. And so part of the reason that the price is going up so much is the features are increasing. The feature set is increasing. Homes in 1984, I'm just going to throw a guess out there. I'm going to say that the typical home sold in 1984 had maybe 1,700 square feet, probably 1,500 square feet. And in 2024, the average home is probably 2,800 or 2,900 square feet. So you get a lot more square footage. You have more garage bays.
Just like the cars, more extras,
more garage bays. So part of the reason the prices are going up, right, is that you're getting more features in the house. So that doesn't explain all of it. That explains some of it.
Mm-hmm.
Feature rich.
Yeah.
In all cases, these are feature rich. So what we need to do is take a look at what I like to do is to take a look at prices. So what I try to do, because by using income from that year and the price of a good, a house or a car, we're stripping away the inflation in some sense, right? Because we're looking at it relative to the income that was earned that time. So it's kind of stripped away the inflation. But inflation will erode the value, the purchasing power of the dollar over time. And so if you look at the BLS, Bureau of Labor Statistics website, they keep track of CPI, the CPI's index. And so
Consumer Price
it's
Index.
indexed at 100 in the
CPI, Consumer Price Index, right?
1982 to 1984 period. It's indexed at 100. And so from that 1982 to 1984 period to today, the price levels increased by almost 4 times. Okay, and so if you look backwards from there, the price level will be lower than that period, than 100. It'll be, if you go to the 40s, it'll be probably 20, and it will be 50 and 70, and it'll eventually get to 100, and that's because it's deflated over time. Oh, and the inflation though is tracked with the level standardized at the 82 to 84 period. Okay. So if we take a look at that CPI data this is May 1947 to 1971. The price level goes from 22 in 1947 to 40 in 1971. That's a 23-year period. The price level does not quite double, right? From 1971 to 1981, the price level moves from 40.1 to 94.1. So now, over this period of 10 years, the price level more than doubled, right? We were looking at the period from 47 to 71, which is a 23-year period, and the price level didn't quite double. And then from 71 to 81, it more than doubled. Okay? Why? Well, an important thing takes place at 1971. And Nixon, who's the president at the time, removes gold standard completely from our US economy. So from the period of 1933 through 1971, the United States was on a gold standard. Bretton Woods to Nixon. And so actually the US was on a gold standard farther back than that, but just for the sake of this little bit of this conversation. So in 1933, the US was using gold. The dollar was valued in terms of gold, right? FDR confiscates all gold from US citizens. If you had gold in your house, you had to turn it in to the US Mint. The confiscation of assets. He did not want that. Why? Well, he wanted to devalue the dollar. So that's a form of inflation. So the dollar gets devalued by 41% because of that. In 1971, Nixon ends the gold standard. Pure fiat currency now. Nothing's backing it. And you start seeing inflation go crazy. Who benefits from inflation?
The government.
Government benefits from inflation.
Yep.
Because all prices rise and they don't index any kind of taxes on CPI. It's on nominal prices. So they're taxing higher prices. They get more revenue. And they do this to fill their coffers so they don't have to tax you directly.
Yeah.
Inflation is very pernicious. If you wanted to have, this idea of even a 2% standard that the world kind of generally tries to adhere to, it shouldn't even be 2%. That's to benefit governments so that you always have a little bit of growth in the price level. The price level could be zero. Inflation should be zero. It could be slightly negative, in fact.
Yeah,
that would benefit people.
Now, bringing it up to today, I think we're running close to the end here. Bringing it up to today, interest rates, how interest rates bear into this equation, just real simply, look, if interest rates are higher, when you make your mortgage payment each month, you're gaining less equity in your real estate investment. So it's taking you longer Each dollar you pay, more goes to the bank and less goes to the equity of the home.
So look at what happens there, even there, right? So you talked about a 40% inflation from COVID 2020 to today. You go to sell your house, and a couple gets a $500,000 exclusion from any kind of gain they would have had on their home. So let's just say this is
Capital gains.
let's say it's a fairly well-to-do family. They've got a $500,000 house in 2019, $500,000 house. And now their house is worth $1 million. Okay. So they would have, of that gain, that $500,000 exclusion.
I know
So
where
they
you're
wouldn't
going.
have to pay tax on
Yeah.
that, capital gain tax. But if that house had gone up to $1.5 million because of inflation, now they're going to have to pay capital gain on $500,000 where they wouldn't have had to pay before.
Government wins.
Government wins.
Yeah.
Do you see how this works?
Yeah.
So the government benefits from having asset prices rise. So I wanted to look at the ratio of gold to home prices so that we could examine that effect, because gold usually does a really good job of maintaining kind of a inflation, internal self-adjustment for inflation, right? So if there's high periods of inflation, gold prices will spike up. If there is not much inflation, gold prices remain really flat. They don't grow much at all.
It's pretty solid benchmark, right?
Over time, gold, because that's why it was always used.
Yeah.
Because the scarcity, the reason is gold's a very scarce commodity. And so it can't inflate really fast over time. So if you see any rapid price increases in gold, it's because of inflation doing that. It's not because that the amount of gold is, adding into the system can't bring the price down, right?
Sure.
Okay, so we have in 1984, we're going to use the same periods. So the price of gold, not adjusted for inflation. So there's no CPI adjustment here. This is the nominal price of gold in 1984, $346 an ounce. The price of gold in 1990, $388 an ounce. The price of gold in 2000, $281 an ounce. Price of gold in 2010, $1,207 an ounce. We moved from, in that 10-year period, we moved from 281 to 1,207. And this is at the time when we had the financial crisis, right?
Mm-hmm.
So we've got two things going on. The inflation, all that inflation that we'd seen from the crazy spending of those days was sort of juicing up assets of prices. And you had the government starting to discount the value of interest so much that the price shot up. In 2020, the price goes up to $1,879. This is COVID, $1,879 per ounce, and now the price of gold is $2,700 per ounce.
No end in sight.
No end in sight. Don't we see some rapid? We saw some stability in the low inflationary periods in the 90s, and we saw a lot of instability after that. So just for fun, we're going to quickly take a look at a home price in marked or priced in terms of ounces of gold. So if we take the nominal price of a house, divide it by the nominal price of gold at the time, we're going to look at how many ounces of gold you needed to buy the house.
The gold standard.
Well, so this is going to tell us, this is going to strip prices away and just tell us how many ounces of gold we would need to buy a house in these different periods. In 1984, you would need 196 ounces of gold to buy a house.
Based on the price of gold at the time.
Based on the nominal price of gold in 1984. And your wages at that time, if you priced those in gold, you would have earned that year 65 ounces of gold. That's a ratio of 3, by the way. In 1990, you had 388 ounces, or $388 per ounce. You would need 254 ounces to buy a house, and you would have earned 77 ounces. In 2000, you would have needed 244 ounces of gold to buy a house, 444 ounces. 444 ounces to buy a house, and you would have earned 149 ounces of gold. That's a multiple of 2.9. Staying close. In 2010, you would have needed 157 ounces of gold to buy a house. So we went from 444, the 2000 period, to 157, even though the price of gold shot up, and that's why, right? So the price of gold went from 281 to 1207 over that 10-year period. And the number of ounces of gold you needed would gone from 444 down to 157. You didn't need that many
Adjustment.
ounces
Yeah.
of gold, right?
Adjustment.
Because the price of gold shot up.
Sure.
It adjusted for the inflation. And you would have earned 41 ounces of gold that year. In 2020, it was 146 ounces of gold you would need. And you earned 36 ounces of gold. And in 2024, you would have needed 151 ounces of gold to buy a house, and you would have earned 29 for a multiple of 5.2.
Wow. So gold is a good barometer.
Gold's a great barometer
Yeah.
for inflationary pressures.
Well, we're going to have to leave it there.
We're going to have to leave it there. If you need to buy a house, buy gold and then sit on it for...
Saying buy a house of gold or just
buy a house of gold. That's the best thing to do.
live in a house of gold?
Hey, if you haven't already done so, please like and subscribe.
Appreciate all the support, everybody.
Appreciate all your support. Thank you so much.
See you next time.